The Precious Metals Week in Review, August 28, 2015. Brought to you by Precious Metals International. Volatility spiked massively this week as further poor data and wild stock moves in China triggered massive stock sell-offs across global markets. The Dow Jones Industrial Average, DJIA, experienced cumulative moves of over 10,000 points this week as it swung wildly up and down, setting records this week both for points gained and points lost in a single day. According to data from Citi, this week marked the biggest single-week outflow of funds from equities since data collection began in the year 2000, as global investors pulled more than $29.5 billion out of global equity funds. The U.S. alone saw $12.3 billion in outflows. U.S. stock indexes continued their plunges on Monday, picking up where they left off last Friday after China's stock markets continued to show clear signs of fear and uncertainty when they opened on Sunday night. The DJIA saw its largest single-day point drop in history as a result of the panic, and all the other U.S. indexes entered correction territory. The massive spike in volatility immediately sent most stock analysts scrambling to reverse their calls for the U.S. Federal Reserve to begin raising rates in September. The number of Americans filing new applications for state unemployment dropped more than expected last week, falling by 6,000 claims to a seasonally adjusted level of 271,000. The previous week's data remained unrevised, and the drop was the first decline in weekly claims in nearly 5 weeks. Continuing claims, those individuals still receiving unemployment assistance after an initial week of aid, rose by 13,000 to a level of 2.27 million for the week ending August 15th. The continuing claims data covered the data survey for the August non-farm payrolls report, but last week's initial claims data will fall outside the survey period and will not be counted in the report. In China, after the market opened on what was still Sunday in New York, investors rushed for the exits as the Shanghai Composite Index posted its largest single-day point loss since 2007, on a percentage basis. The Shanghai Composite plummeted 8.5%, falling to 5-month lows and triggering additional intervention steps by Beijing to try to halt the slide. The plunge triggered sell-offs in most global markets on Monday, resulting in near panic in stocks as the rout spread across the globe. Following Monday's stock rout, and with evidence that the plunge would continue through Tuesday, the People's Bank of China cut interest rates and lowered the amount of reserves that banks must hold for the second time in as many months. On Wednesday, the PBOC injected 140 billion yuan, that's $21.8 billion US dollars, into the economy via a short-term liquidity operation, STLO, according to the central bank's website. Since the announcement was made after Chinese stocks closed for the day on Wednesday, local markets were little affected by the announcement. On Friday, the central bank said that it had injected an additional 60 billion yuan, $9.39 billion, in yet another STLO. China, the world's largest holder of U.S. debt, also appears to have sold off at least $106 billion of its reserve assets since devaluing its currency earlier this month, according to Societe Generale analysts. A Bloomberg report released on Thursday, citing people familiar with the matter, confirmed that China had cut its holdings of U.S. treasuries in order to raise U.S. dollars needed to support its moves in the yuan. We find it notable that China chose to sell off treasuries and not some of its gold holdings to raise the needed dollars. Elsewhere in Asia, consumer prices for July in Japan were unchanged from a year ago, indicating that the Bank of Japan, BOJ, is continuing to experience trouble in reaching its 2% inflation target. Analysts are now beginning to speculate that the BOJ may need to institute further stimulus measures if it expects to realistically hit its inflation target next year. On Saturday, Russian Prime Minister Dmitry Medvedev said that the government and central bank were preparing to engage in foreign currency sales in an attempt to boost the weakening ruble, which has fallen 23% against the US dollar over the last month. Such a move could mirror similar moves made last December, and analysts speculate that Moscow could order state-owned exporters to follow suit with their own currency sales once again. Most feel that such a move would be ineffective for Russia's economy and the ruble in the face of continued downward pressure on oil prices. Crude oil got hammered along with the rest of the world's markets this week, hitting 6.5-year lows as stock markets tumbled wildly. Crude had regained ground by Friday and was back into the mid-$40 a barrel range as equities showed continued signs of recovering, and news broke that Nigeria was experiencing low crude supplies due to a pipeline outage. The euro began the week moving higher against the US dollar, but had lost momentum by late Monday and began moving lower from there. The euro continued its downward moves through late Thursday and then attempted a slight recovery, which lost steam early Friday morning. The euro will close lower against the US dollar for the week. The Japanese yen saw a sudden spike higher against the US dollar at the start of this week, but it too peaked on Monday and then began drifting lower. While the trend lower continued for the rest of the week, the yen still appears set to close the week higher against the US dollar. Volatility should be expected to continue, especially if global uncertainty continues to increase dramatically in the coming weeks. The fallout from the wild swings in global stock markets this week is likely far from over and may have long-term effects on the behavior of both institutional and retail stock investors alike. Next week, we'll see the release of key data points in the U.S., which could have direct bearing on the Federal Reserve's decision on whether to proceed with a rate increase in September. The non-farm payrolls report for August will be released on Friday, and if it shows continued improvement in the U.S. employment sector, it will mean the Fed will face further pressure to proceed with raising rates, despite what seems to be a clear and increasing weakness in the interconnected global economy that most analysts now feel should mean delaying such a move. Asia, China in particular, will once again be the key region to watch over the weekend as the world tries to absorb further direct intervention into markets by the Chinese government. In Greece this week, the split among the ruling Syriza party continued to widen as 53 of the 201 members of the Central Committee of Syriza all submitted their resignations, saying that they cannot serve under the new austerity program that was agreed to as a condition of the latest bailout. The rebel members of Syriza have begun to form their own separate far-left and anti-bailout party that they intend to see gain power during snap elections that are expected to occur in Greece by September 20th. Any revival of anti-austerity campaigns by the incoming Greek government are near certain to result in a failure to receive the bailout funding most recently agreed to between Greece and its international creditors. The first official opinion poll published since former Greek Prime Minister Alexis Tsipras resigned last week still shows his Syriza party leading among those polled, and it remains to be seen on whether his gamble to consolidate power will pay off for him in the upcoming election. In Russia this week, the Western goods destruction campaign continued as Moscow's food and agriculture watchdog confiscated and destroyed 1.6 metric tons of German supplies intended for drivers of the German DTM motor races, which are taking place in Moscow over the weekend. According to Russia's state news agency, the German team always brings its own food to events, but the attempted crossing of goods lacked the proper documentation, and so was subsequently confiscated and destroyed. As the destruction of Western goods, particularly food items, seems to be accelerating in Russia, open criticism by Russian citizens over President Putin's retaliatory policies seems to be rising in tandem with the cost of food there. The Russian ruble has also been cratering against the US dollar over the last month, dropping 23% and exacerbating the economic woes that had already been brought on by plummeting oil prices. In Ukraine, the finance minister announced this week that Kyiv had completed a deal that would see its largest private creditors write down 20% of the $18 billion that Ukraine owes in debt. Ms. Natalia Yaresko, the finance minister in question, described the deal glowingly, saying, "Everyone's done well out of this deal. That's why it's collaborative. It's no one side winning, it's a win-win situation. We're all now moving forward without putting the value of the bonds at any further risk." Not mentioned in the deal, and likely not to occur, was the participation of Russia in the agreement. Ukraine owes $3 billion in euro bonds that were issued to Russia in December of 2013 and are set to mature in December of this year. Quietly released by Bloomberg during the turmoil this week was a report that the European Commission is investigating precious metals trading at some of the world's largest banks for manipulation. The article can be found on Bloomberg by clicking the article title, "Precious Metals Trading is Probed by EU After U.S. Inquiry." The article is short and well worth a read. Just the fact that Swiss-based UBS, the very bank that gained immunity for blowing the whistle on a LIBOR manipulation which resulted in massive fines to these banks, said it had also gained immunity in the investigation into misconduct in the trading of precious metals, may mean that this investigation actually does have some real teeth and we will finally see some real results. As we await further news out of Asia over the weekend, it remains vital not to let the herd mentality that took over the stock markets this week rule the day. Make your investment decisions based on logic and not raw emotion and panic. More and more reports surfaced this week that mining companies are being forced to further scale back their production due to declining profits amid China's slowdown. If wild stock swings continue in the coming weeks, investor focus and sentiment may once again shift back to precious metals as a store of value during times of uncertainty, and these same mining companies may no longer have the production levels they need to meet that demand. If that proves to be the case, then surging demand could lead to a massive and sudden surge in prices, just as it did in 2010. Remember that precious metals should always be viewed as a long-term investment, and that the key to profitability through the ownership of physical precious metals is to actually acquire and own the physical products, and to hold them for the long term. Always remember that you should never overextend your ability to maintain ownership of your precious metals over the long term. The Precious Metals Week in Review, August 28, 2015. Brought to you by Precious Metals International.